5:59 a.m. Pacific Standard Time, 5/3/2012. And what are we here to do today? We're here to make a market. That's what we're here to do. And how are we going to do that? The public, you know, you see 607.55 and you see 609.36. And you know beyond a reasonable doubt that you don't even know how to deal with that bid and ask. Because you don't. That's how wide that is. Let this be a lesson. When I say that price volatility is going to increase in round 2, second phase, you better believe it. And if you don't know how to get in here, and you don't know how to get out over here, and you don't know how to make a market like a market maker, well, you're not going to survive these bid and asks. And I know it. And you know it. Beyond a doubt. And if you got a question, then get your rear end in here and find out and see it for yourself. We'll settle it that way. Let it be known right now that I'm looking at how that print's going to open up and how I'm going to steal that 615 put here, now, live on that opening bell. There's nothing fake about it. Let's get that straight. It's all about that bid on that side. And let us not forget that this call contract that expires and this thing can't get above it, then you know what? This would be what we call a Friday play. Short that and let him go to zero and walk away with the whole pie. Okay? One of the things that we're going to be looking at, and the only reason why that's up there is because that is a different type of market maker trade that we would do and walk away with all of the money. So if these got up to like $1.85 and we have a couple hundred contracts short and they go to zero, well, you make that much money. Those are called Big Friday paydays. Yeah, they are. You wouldn't know how to do that. But here, let's focus on the bid and the ask. If we open up, and here's qualifier 1, MMT, on this print, if he opens, if someone throws a print, it's only a $2 gap. That's all it is there. So, from the ask side of it, you got a 609.26 with a closing bell of 607.26. Wow, sounds like $2 to me. Flatline. Now, on the opening bell, if this stock runs up toward that 612.75 to 613.80, 2 pennies, and stops there, that means that this side of the transaction, that 615 put at that wholesale price. That's what everybody wants, and we all know that. So let's don't fool it. It's all about that risk and how they open that print. Right now, the market will open in 28 minutes. On the invert of the $600 call, yesterday's low was 540. Let's see how many contracts traded, 458. Heck, we buy almost that much ourselves. But they were up $1, only ended up, but look at the range. They hit a high, 9.5, then they slid the bid. But you had a range of 7.8, and they had that low yesterday on that side of the market. And that's that $600 call. But look at that bid and ask spread. And you don't even know what to do with it in pre-market. Let's be honest about it. We do know how to get these entries. We do know that the criteria is if this goes up there, I'm going to start 50 contract bid right here, right now at 440. I'm going another 50 at 470, but I'll work my way up into the 525.50 area, which is still a $3 clip below the bid wholesale on big volume. When this thing stalls out at resistance, I know how that bid and ask is going to work. I do. Now on the invert, let's say the bid disappears here at 607.56, pops over in front of that ask, and then starts selling that down. I'm going to be looking at what? Getting that $600 call, and I'm going to line that bid at 3.5 on 50. I'm going 390 on 50, and I'll start another 50 just knowing that I need to be in the neighborhood of somewhere right around that 480 area Okay, and yesterday's range was $4.10. Now let's keep that straight. And what that meant was that there was a profitability trade. And we only want to tell it how it is. That's why we're opening our new options pit. It's about $10,000 seat. You get one of these trades, well, then hey, you're smooth sailing. Bottom line, SMF is launching a new service on its new website, which you'll see if you're watching the video. And that means exactly what it means, an option pit. So basically there's that bid and that ask. And I will tell you, depending on which way they slide the bid, that means and what do I mean by that, MMT? They could print down here and make that print on the opening bell and then run it up to these numbers in here. So that's how that opening print, that's how this side would qualify. This side, if they do that on the opening bell, these prices here would peak at their highs, as this one here is making their what? Lows for us market makers to steal that wholesale bid. Depending on that opening bell with that wide bid and ask gap, 607.56, 609.43. And the public doesn't know how to deal with these. They sit there and say, oh boy, what do I do? Well, hey, we make markets. We understand all the intrinsic little dirty secrets behind closed door 1, 2, and 3. And that's the mechanics of the tape. True story. And how do I operate within that $2 bid and ask on the opening bell, and how that $600 call will be affected, and how this $615 put in money will be affected. There's this 610 put. We have it sitting down here, so we're still looking at that one. Oh yes, we are. That we are. So basically that covers the pre-market evaluation. Here's a 615 call. I have it featured for one reason. Tomorrow is the weekly expiration. And if Google cannot clear that 615 area, we're going to see if it can. If no one says it doesn't go right up here to the 615 area, it can break out up there on the opening bell. Or they can cross the market and sell down, and the call would come into play on that transaction first. One is going to peak in either direction. That's when you're going to look at how to take advantage of how are they going to price this option based on that bid and ask spread of the equity. And what are the people in the option pit going to do when they price these options based on this wide spread here between the bid and ask and pre-market, and how that opening bell is going to affect both prices on both sides of that trade. We'll be looking at many other trades today. We have a Jobs Friday unemployment number coming out tomorrow. Jobless claims came out today. Visa had the earnings report. There's all kinds of stuff in the public sector that's going on. So what? We're here to make a market at the end of the day. That's what we do right here in that bid and ask. Now, for a lot of MMTs that are brand new, you haven't seen that wide bid and ask. And why would price volatility increase? I forecasted that for the first trading day of April of 2000 calendar 12. And now, with the second new alert, I am telling you that price volatility will increase. And you'll always see it in the bid and the ask. Special preview Google, 615 put, $600 call, 615 call, which is up and out of the money, with a line in at 610 put at wholesale entries.